Hey guys, this is Tim Melvin coming to you from down here in Central Florida. Very nice, hot, 94-degree day down here today. Just loving it. Love the summertime in Florida. But I'm coming to you. We haven't done much with the videos in the last couple weeks. Been trying to try some new things, figure some things out. Doesn't seem to be a huge demand for it. If I'm wrong, email me and let me know. But we'll get back to a regular video, but this is our super emergency, super important market volatility video offering. Now, I've been told that this is pretty much mandatory if you have a newsletter service. Anytime the market moves more than a percentage, one way or the other, we all have to get together and have very panicky discussions about what on earth we're going to do now with all this volatility. So here's my suggestion post Brexit. Let's just relax, okay? For those of you that are subscribers to the Deep Value service, you know that for the past several weeks, we've limited the buy list down to about 4 stocks. We just have not felt like, let's put in use the right pronoun, I have not felt like this is a great place to be chasing stocks. Not a lot of safe and cheap stocks out there, which is usually a huge warning sign. Drops every time I run the screens. Markets at about 23 times earnings coming into the Brexit vote last Thursday, and we're at the tail end of a 7-year bull market. And I hear the bullish arguments: low interest rates, borrowing money, buybacks, and they all sound horrible to me. So we've kept what we've owned. We've not been out there selling a whole lot of stocks, but we just haven't been buying either. Market has, not been a good place to put new money since earlier this year in February. And of course, we were buying a few stocks in January, February when the market pulled back a little bit. But post Brexit, okay, look, we're down over somewhere between 5 and 10% as I'm making this video from the highs. The last 2 days, Friday and of course today, not real pleasant if you're long a whole lot of stocks or you own the indexes. It's been kind of sloppy and ugly. A lot of fear out there and a lot of talk. And I think that's what makes me crazier than anything else. What is the impact of Brexit? What now? What's next? And everybody comes on and they've all got an answer and nobody's given the right answer yet. Here's the right answer. I don't know. I have no idea. A country leaving the European Union, especially when the size of the United Kingdom, hasn't happened yet. Now, I've heard that this is going to be great for the euro, bad for Britain. I've heard it's going to blow up the United Kingdom, that Britain's going to grow. One of the wilder theories that I've heard is this will lead to the rebirth and reforming of the Soviet bloc. All kind of crazy theories out there, and it's probably not good in the short run. There's going to be some economic disruption in the United Kingdom, maybe some in the Eurozone, and it might spill over to the United States, slow growth down a little bit. But we don't actually know what's going to happen. And so far, it's sloppy, it's painful, but it's starting from a very high level. So it's not an inventory creation event just yet. So just take a deep breath, relax. We've got over 40% cash in deep value, the same in the international deep value. The income portfolio is fully invested. We're generating a ton of income off that portfolio, and some of the stocks in there, as we'll talk about in a minute, actually have positive momentum even during all of this mess. So I think we're going to be okay with about a 90% invested position in that portfolio. And of course, our small banks, guys, they haven't done much. They don't really care. They don't own a lot of British pounds. They don't own gold. They're not doing trade agreements with the European Union, not doing a whole lot of business in the United Kingdom. They're doing business here in the United States, and business is okay. I'm not sure I'd be running out to buy a whole bunch of commercial real estate as those markets have appreciated. Residential real estate's just okay. We saw the housing reports last week. Existing home sales were up. New home sales were down. Still, there's a problem there with new homes. They're building too expensive new homes. It's out of reach of most buyers. So it's going to spill over, be a positive for existing home sales, and we'll see what happens with the new homes. There's a lot of money to be made, I think, building the $200,000 homes. But so far, only the independent builders are in that market. I love the home builders long term. I think this will be a grinding, slow, long-lasting recovery, but not really ready to quite pull the trigger on the group. I do have a couple special situation stocks that I tucked away for the next decade in the higher risk portion of my portfolio. But if you look at the small banks, U.S. real estate markets are fine. U.S. business is okay. We saw a little bit of a tick up in some problem loan categories, most notably commercial and industrial, in the first quarter call reports, but starting from a very low level. So they ticked up, but they're still historically very low. Lots of clear sailing ahead for the smaller banks. And then the other thing that has to come into play here, a lot of bankers that I've talked to over the last couple of years really felt like eventually the Fed was going to be in a position to raise interest rates. And if they could just hang on until those net interest margins got better, they'd be able to remain independent. Well, today, starting with that horrible jobs report a couple of weeks ago, and now with Brexit today and the economic fallout and all that, it's a different conversation in a lot of boardrooms and bank offices around the country because Yellen and company are not riding to the rescue. There's not going to be any substantial interest rate increases for a long time. And Louis Navellier told us last year that he didn't think they'd ever be able to raise interest rates in his lifetime, and he's looking like a really smart guy at this point because I just don't see how they're going to engage in a sustained series of interest rate increases anytime in the next few years. I saw a Goldman Sachs report the other day that was passed along that had their economic growth forecast, and it's just not pretty for the next several years. So we may be in lower for longer as the new normal, and that's going to have a lot of the smaller banks are just going to have to bite the bullet and sell. Now, the average takeover multiple is about 130%. We're buying most of our financially solid small banks with strong loan portfolios at around 85 to 90% of books, some much lower than that. So if they go out an average premium to book value in a takeover, we're happy campers. We have some banks in our portfolio that have turned into serial acquirers and are doing a fantastic job of growing their earnings. Now, brings me to my next point. As Brexit continues, the regional banks are getting crushed. Many of them down more than 10% just over the last 2 days. If that continues, if you've been following me for a long time, 2008, 2009 into 2010, I guess let's say, we were buyers of like the Huntingtons and the Regions and the key banks, and we did extremely well with them. I think BB&T is one that at the dead bottom of the crisis, it was actually cheap enough. We had about 15 minutes where we could fire off an order at a price that we were willing to pay. And those banks turned out tremendous, very large gains for us. So if this continues to spill over, I don't see those regionals as being overly exposed to the European markets or to the derivative markets. We'll go back through and check the loan portfolios to be certain before we pull the buy trigger. But if this continues, to be able to buy some of those super regionals, or as I wrote in an article on Real Money, how cool would it be to be able to buy Home Bancorp if that thing got down under 15 times earnings? We're never going to get that on a book value basis. But John Adelson and his team have done a fantastic job of running that bank. I believe that his goal is to get earnings to 250 a share, big leap from where they are now, but not going to bet against him either. Get a 20 multiple at 50, and maybe then he'll be able to retire since he owns 11 million shares in the bank. But there's going to be some interesting opportunities if this continues. There is no way of knowing if it will continue until it does. So let's all just relax. Quit trying to figure out what's going to happen because it's not knowable in advance, okay? We are in a position with a lot of cash to react to what the markets actually do. And that will make us a ton of money if, in fact, this turns out to be a major inventory creation event. I hope it does. I don't know if it will. So that's kind of where we are. What's next after Brexit? I don't know. Neither does the guy on TV or the person that wrote the really cool editorial in the financial journals. Nobody knows. So let's just wait, relax, see how it all plays out over the next several months, even years. Now, on the bright side, Baltimore Orioles, first place by 4 games, just took a 4-game series from the Tampa Bay Rays. Things are looking good there. A bunch of new books out in the last few weeks to help you get through this crisis. I want to mention one other thing. Earlier this year, or kind of January to be exact, we spent just a ton running models and testing things and ideas and came up with a few that were really strong, and we've been tracking them. And one of them is the value momentum portfolio. And all we did there, not rocket science. We had talked to Tobias Carlisle, Wes Gray, Gary Antonacci, who wrote Do Momentum, and we started to get some ideas about factoring momentum into a value portfolio. And what I did is I took stocks that traded below book value, and then we limited the universe to just those that passed a dual momentum model. They had to have positive 52-week performance, and they had to be outperforming the S&P 500. Then we bought the 50 cheapest stocks in the remaining universe based upon price to book value, back tested it all the way back to 1999. That's how far back we were able to get some good data. This thing crushes the market. I mean, it just, in good years, it outperforms to the upside. In bad years, it does a tremendous job. And more importantly, when you look at the really bad years, the 2001s, 2002s, the 08s, the 09s, you're not able to find 50 stocks. You're holding significant portions of your money in cash because most of the stocks fail one of the two momentum stocks tests. So very strong model, something we're looking at incorporating more and more. Just rebalanced for the first 6 months of the year. And it outperformed again. The model returned almost 5% versus the market's less than 1% year to date. And of course, 10 basis points on the Russell 2000. So it crushed that. Now, when we rebalance, what we find is, once again, just as in the first 6 months of the year, half of the portfolio is in small community banks. That is the place to be. I'm comfortable with having 50, 60, 70% of my money, all of my money in the sector if it came to it. So owning a bunch of small community banks below book value that have a little bit of price momentum, really comfortable with that idea. The other small REITs came into play. So did business development companies and mortgage REITs, which should actually do okay as a result of lower for longer. They're going to be able to take advantage of the spreads of borrowing at very low rates and lending in the commercial markets, what are higher rates for the business development companies and manageable spreads for the mortgage REITs. And that's, these things are yielding anywhere between 10 to 14%. That really gives you some kick and some cash flowing through the portfolio. So community banks, smaller REITs, where we are seeing some M&A activity, by the way, business development companies, mortgage REITs, handful of insurance companies, all make that top 50 for the value momentum portfolio. So that's working right now. I think that's where we should be continuing to look as we look for ideas. Mostly we're going to sit back. We're going to wait for the market to tell us what to do. Community banks and cash remain the watchwords of the day post-Brexit. So that's really all I got for you. We're not there yet. We might get there. Everybody take a deep breath. We got lots of cash in the portfolio, so even if the markets go down, we're not going to get hit too bad. If you're holding a heavy mix of community banks, as I've suggested for several years now, you should. You may not even notice this on your account statements, because when I looked the last couple of days, some are up, some are down. The mix net effect is pretty flat across the portfolio. So, and in the smaller bonus banks, which are the ones that have been too small to even put in the portfolio, we're actually, I think, up just a tiny bit over the last couple of trading days as the world has done its best to go absolutely insane. So anyway, discovered some great new books. If you really need to take your mind off all this stuff, baseball is not enough to get it done for you. First off, if you haven't read Tobias Carlyle's new one, Concentrated Investing, he was one of our three-member team that wrote that book. It's fantastic. Go get a copy. Eye-opening and educational on concentrated value investing. Wonderful book. But I found a new series of books. I love these things. Got my Amazon credit from the Apple price fixing lawsuit. I'm not going to pay for a book again for an extended period of time. I did not realize during the time frame back then that the lawsuit covered. I apparently spent a fortune on ebooks, and I got a whole ton of money back from that price fixing thing. So Apple, thank you very much. We deeply appreciate it. Please plead guilty to more price fixing charges sooner. I could, buy a whole bunch more books. That was very nice of you guys. Anyway, there's a group out of Sarasota, Florida called Pineapple Press, and they've been publishing something called Cracker Westerns. And I love these things. I've always been a big Western guy. Read the Zane Grey catalog, read just about everything Louis L'Amour ever wrote, and I just love Westerns. I love the theme of them. There's definitely kind of a morale that runs through most Westerns. They're relaxing, they're entertaining. You learn a little bit. A good Western writer like L'Amour has some history and some biology and some other things wrapped up into it. Cracker Westerns, called Crackers, because they're set in Florida. A little bit in South Carolina, but South Carolina, Florida, about the same time as the L'Amour novels, right before, right after the Civil War, the last kind of days of the Wild Wild West, when all the legends and stars were kind of running around out there, Buffalo Bill and Jesse James and all those guys. So same time frame, And they do weave a tremendous amount of Florida history, Florida biology, I guess is the word that we'll use. And it's just, this is a tough state. If you've ever driven through here and looked off to the side of the road, with the swamps and the palmetto, just, I can't imagine what it was like to settle this place with, panthers and mosquitoes the size of your horse and alligators and the snakes and all the crazy stuff that exists in Florida today. And can you imagine how much more there was back then? So anyway, these books are fantastic. I've read three of them so far. Really enjoyed every one of them. So it's Pineapple Press out of Sarasota, available on Amazon, $3 to $4 a piece. Great. Take your mind off of Brexit reading, kind of dive in there back, when it was just England and Florida wasn't even a state, and kind of lose yourself from all the madness that's going on in the markets right now. So my super important market fluctuation message to you is relax. Don't try to predict what's going to happen. We're in a great position to profitably react to what actually does happen. So community banks, cash, cracker westerns. That's the game plan for the month ahead. I'll talk to you guys again.